Welcome back, traders. John Caruso here with your trader tip of the day. Taking a look at the broader stock indexes, we are down on a week-over-week basis, approximately 3% in both the S&P 500 and the NASDAQ. We are starting to see some signs of disinflation, both in the growth component of the economy as well as in the inflation component of the economy. Now, it hasn't quite shown up in the data yet, but we do believe with the persistent levels of inflation we've seen in the back half of last year and the beginning part of this year, that is going to start to slowly affect U.S. GDP growth, and we do believe that's going to bleed into not only the consumer, which of course is 70% of the economy, but ultimately corporate balance sheets. And we're going to be entering the earnings season over the course of the next 2 weeks, so we're going to have some more data on that. So I do believe right now you have to be extra cautious if you're looking at positioning long in the market right now. I mentioned before we are immediate term oversold right now in stocks. However, all of the reasons we had going for us last year at this time and why we were bullish on the stock market last year at this time, we no longer have those reasons right now. Last year you had the Fed cranking at $120 billion in QE. You had stimulus checks going out. Corporate balance sheets were strong and accelerating. We no longer believe that that is the case. We do know that the Fed is very hostile right now. We did recently hear from James Bullard at the Fed, who mentioned that we could see potentially 3.5% Fed funds rate by the end of this year. Now, whether or not that comes to fruition, that's beside the point. That's what they're telling us they're going to do at the moment. So you have to be very careful if you're looking at positioning on the long side of this market going forward. I'm John Caruso, and that's your trader tip of the day.